Hey everyone, in this video I'm going to make my case for why Zoom video communication stock, which is down 90% off its highs, is an excellent investment at current valuations. I'm going to share with you its revenue growth, its operating profit margin, cash flow from operations, the pristine balance sheet, the risks going forward over the next 5 years, and the recent trends in customer behavior at Zoom Video Communications. So let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So like I mentioned, Zoom Video Communications down 90% off its high, or 89.72% to be precise. However, Zoom Video Communications hasn't experienced a big decrease in business. You see here its trailing 12-month revenue, $4.563 billion in the recent 12 months. It's not down, right? You might believe that, Zoom was a pandemic business, and now that economies are reopened and people are back to work and kids are back in school, that Zoom video communication is doing poorly. That's not the case. Revenue has held up. What slowed down is revenue growth. It's not growing at the rates it increased in 2020. You see that big explosion here, right? It's not growing like that, but it still maintained the business, most of the business that it attracted during the pandemic. For instance, I'm still using Zoom video communications as a professor during moments when it's necessitated. For instance, over the last couple of weeks, our university campus has been closed because of protester violence on campus. And so over the last 2 weeks, I've been teaching my classes through Zoom video. And so there's still use cases for this technology, this very convenient technology that so many people have now learned how to use. That's the key advantage for Zoom video communications over all of its competitors, which there are competitors. But the key advantage for Zoom video is that so many people used it for so long during the pandemic that it's created less friction to adopt for business, because they feel confident that their employees, their customers, those they interact with are familiar with Zoom. They'll know how to use it if they need to use it during business hours. So that's a key advantage here for Zoom, and I think that's one reason why the company's been able to sustain the revenue it gained during the pandemic. So they also have some growth drivers that are underlying the company's growth, even though they're not meaningful just yet to drive the overall growth of the business, because it's offsetting some of the declines from legacy customers. So if you think about their contact center business, that's up 246% year over year. And this is an area potential growth for Zoom video. The contact center has been an area I've been talking about that needs disruption. Doesn't work the way it is current form. It drives customer dissatisfaction, and it's costing businesses sums of money to operate their contact center business. It's not working well, right? So if Zoom video can improve on the process, of course, if you can have a video chat with the business that you're trying to contact, that's going to lead to a more fruitful outcome than if you're just calling over the phone, right? Just avoiding the annoyance of getting asked 7 or 8 questions that you have to answer on your phone. And then when you reach a representative, that representative proceeds to ask you the same questions that you were just asked to type in on the phone to begin with. So it's a hassle. And if you can have the video, it can eliminate a lot of that hassle. They're also adding Zoom phone customers, and these are with over 100K seats. They added 5 more customers, and they passed 700,000 accounts, enabling Zoom AI Companion as of today. You hear me talk a lot about remaining performance obligations, RPO, as an important metric for businesses that have recurring revenue or sign annual long-term contracts. And Zoom Video is still increasing its RPO, remaining performance obligations. The year-over-year growth in total remaining performance obligations was up by 5% in the first quarter of its fiscal year 2025. That's right, Zoom Video is one of those annoying companies that has a fiscal year that's different from the calendar year. Companies are allowed to do that. Zoom Video increased their total remaining performance obligations by 5% year over year. So this continues to support the story that Zoom Video is not losing massive amounts of customers as economies are reopening. It's just so much more convenient to work remotely or to do these things remotely over Zoom Video than it is to do it in person. Business meeting with an individual that lives in a different city or a different state or a different country, so much more convenient to do it over Zoom Video versus it being in person. How much extra value does being in person have to create in order to offset the convenience advantage of doing it over Zoom Video? That convenience advantage is massive. And I highlighted earlier my use case as a professor at university. Another thing I use Zoom Video for is office hours. That adds so much more convenience for both myself and the students, because I would prefer to have office hours from home, and students would prefer to have office hours from home as well, because then they don't have to travel to campus and I don't have to travel to campus, and we can do it over Zoom Video and we can get the questions resolved in most cases. So there's so many convenience advantages with Zoom Video, and I highlighted earlier that its strong competitive advantage is that so many people already use the software, they're familiar with it, and so it decreases the friction from adoption. Additionally, Zoom Video is a healthily profitable business, and there were concerns. So I highlighted earlier that when the economic reopening started gaining momentum, Zoom Video didn't lose very many customers. But what did happen is Zoom Video had to work harder to retain those customers. You can see that in the huge drop off in its operating profit margin from close to 30% all the way down to almost 3%. And so what Zoom Video had to do was offer better terms, negotiate more incentives, spend more time and effort in closing sales, and so that brought down its profitability. But that has since recovered, and you can see that sharp rebound here. It's now back up to 15.75%. So an excellent job from Zoom Video in recovering its profitability after the early moments from the economic reopening, having to really push hard to retain those customers. And now they've kind of returned to expanding operating profitability. And a similar story with its cash flow from operations to sales. The company generates a very strong 39% cash flow from operations to sales. And then I highlighted that it has an absolutely pristine balance sheet. It has zero debt and $7.37 billion in cash and short-term investments. And the company is trading at a market cap of just $18 billion. So almost half of its market cap, it's in cash and marketable investments. So one of the risks I highlighted was the earnings per share prospects for the next 5 years. According to the Wall Street analysts that are following Zoom Video stock, they forecast the company is going to increase their earnings per share by just 1.5% over the next 5 years. And if that should be the case, then Zoom Video Communication will likely not perform very well. The stock price will not perform very well. However, according to my research, I feel Zoom Video's earnings per share prospects are better than what Wall Street is estimating. Several catalysts include the fact that the company is still growing revenue on the top line. It's growing its remaining performance obligations, which will eventually turn into revenue. it's expanding its operating profitability. So those existing revenues are going to come at higher profit margins because they've been expanding their operating profit margins. And finally, the company's utilizing its $7.5 billion in cash and marketable securities to buy back shares, reducing the share count, thereby increasing earnings per share. So all of those factors, I think, could lead to earnings per share growth in the mid to high single digits over the next 5 years, much higher than the 1.5% earnings per share growth forecasted by Wall Street. And finally, the stock is very cheap, in my opinion, trading at a forward price to earnings of 11.43. The primary reason the stock is trading this cheaply is because of those poor earnings per share expectations on Wall Street over the next 5 years. So for all of those reasons, I think Zoom Video is an excellent stock to buy. In fact, I have it rated as one of my top 25 stocks to buy, and I'm going to reiterate that recommendation here today in this video. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.